Hello, everyone. This is Tom Harden.
And Brandon Bischoff.
We're here at Canterbury. Today is April the 16th, 2019. And Brandon and I are going to give you an overview of the market going back for maybe 6 to 8 months. We've had a very interesting period. And we will start with a chart of the Standard & Poor's 500.
So this slide here shows the S&P 500 in conjunction with the Canterbury Volatility Index highlighted here below. And you can see these two black lines down here are show volatility between 75 and 45. CVI below 45 is considered to be extreme low volatility, while CVI above 75 is generally considered to be higher than normal volatility.
So if we look at the market here over almost a year period, you can see to the far left that we entered into an extremely volatile period, which was preceded by a low volatile period, kind of like we're seeing at the end of this chart. Also, if we look at our volatility index, you can see as we near the end of October, as volatility drops below 45. The analogy I've used before is like squeezing down a spring. If you squeeze down a spring long and tight enough, then you usually get a pop in volatility and you'll see one or two outliers. So that's what the market looked like through the end of October, through the middle part of October 2018. Now we'll move forward. Okay, Brandon, well, this chart picks up where the other one left off. If you look at the big black arrow at the top, you can definitely see a change in the market environment from being extremely low volatility and upward trending to having a big outlier where you can see this little oblong circle. And I mean, that's a big outlier. That's probably more than 3%. This whole decline from the peak to the bottom is about 10%, and that would be considered still a normal correction.
Bull market correction. And then what we can see happen is the market starts to trade in sort of a rectangular formation. So you can see off the bottom here at this 10% mark, the market rebounds back, gaining about 50% of what it lost. And then it sort of hits a period of or a place of resistance up here, comes back down to the support level of minus 10%. Rallies back upward, and then drops back downward down to here. So it's really been trading in this box range of what we consider a normal bull market correction. But you can also see that volatility is still really high here, upwards of 95.
And you can see it kind of bounce up just a little bit. You might think that these points at the bottom, which is where supply and demand shifted, that would be support, and maybe that's going to hold. But as we go to the next chart, you can see that they did not hold. And we would pick up here along this dark black line, yeah, that right there. And you can see that it breaks down. And that's about another 10% in about 6-7 days. That's
so down from this point, we're down almost about 20%, 19 point something was the actual number. And you can see volatility is extremely high here. But volatility then kicks back on the upside. You can see the market then rallies back. And we have studies going back to 1896 on the Dow Jones Industrial Average. And what we found is there's 7 occurrences where you're going to be in what we consider extreme low volatility and then entering into a period of extreme high volatility or straight to a more transitional bearish market out of a low volatility bull market. And what we found is this drop is actually the largest decline ever experienced without getting at least a 40% retracement. This right here would be close to a 50% retracement. So it's kind of an anomaly, of what sort of happened. If you ask most investors, hey, do you remember what happened in the market on December 24th? They're not going to really remember how they felt back then.
Yeah, this is really kind of like stretching a rubber band. You get that much of a pullback from really a dormant market, then you're going to get an equally sharp rebound. And this is why portfolio management is so important, because most people would tend to lighten up or maybe even get out there towards the bottom. And we want to be sure that we have at least as much exposure, if not more, on this kickback rally as what we had on the way down. Okay, so this chart picks up again where the other one left off. And if you see number 1, that would be the rebound that Brandon just talked about that got us back to that area of what was support and now resistance. Now, if we couldn't see beyond this point, you'd have to say at this point we really need to reduce the risk in the portfolio. We got the full rebound back, and the probabilities here would be that you'd see typically a little pullback here of maybe half the distance or maybe retest the old low. Actually, that's what happened the time before. But again, markets tend to do kind of the opposite of what you think. And from here, you can see it continue to go up about another 10% without a 3% correction. So again, this is a very rare occurrence, and risk management is critical in a situation like this because we really don't know which direction it's going to go. And in this case, it just kind of went straight up. And you can see if you go to number 2, to 2A, that's been about a 20% kickback rally over a period of about 3 months, which is, again, not very efficient.
And just pointing out, you can see that throughout this entire run here, volatility has been steadily declining. I believe CVI's high was about 129 on January the 4th, which is right here. And it's now reached a point of about 64, 65 up through Friday's close.
So we've seen pretty much full range over a period of a few months, extreme low volatility followed by that big outlier in October. Sideways movement, broke to the downside, dropped very fast, came back fast, and now we're almost back where we started. So now we'll take a look at our portfolio thermostat. And coming into this, if we look at the top of the right, you can see the peak in our portfolio was in that October, September area. And actually, at that time, we had a couple inverse funds.
Yeah,
right?
we had the inverse 10-year treasuries, we had inverse EFA, and inverse emerging markets.
Yeah, so that would help stabilize a decline, but we can see again that sharp drop decline. We had maybe an 8% or so drawdown until we get to that level of support. And then it goes into a trading range. And then we see a sharp drop here, which is unexpected because our objective is to not drop more than a normal correction, 8, 10, 12%. And you can see that this exceeds that at this point. And again, when we see something like this occur, which is very rare, it's really kind of similar to like the flash crash, if you remember that back in 2011. Where, say, if the flash crash, the whole thing lasted 45 minutes to make a round turn. If that would have happened at the end of the day, you would have actually printed a 10 or 11% drop, and then the next day it would have been right back where it started. So we saw this sharp drop, and one of the keys to portfolio management at that point is, again, keep at least as much exposure on the kickback rally as what we had on the decline, and you can see that occurred. So as the market got back, you can see we're right back to that 8-10% drawdown from the peak. And the question then is, from a portfolio management perspective, we have no idea where this thing's going to go. I mean, it's an irrational environment. We would think that you'd probably pull back some, at least half of what this gain was. So at that point, we began to adapt the portfolio. And the whole idea there was to stabilize.
And yeah, to sort of reiterate what's been kind of said on the previous slides, this 50% rebound line that was support on the market now becomes overhead resistance. And it's going to be kind of hard for the market to break through that. So that's why when Tom says we stabilize, the expectation from this point here is there's a higher probability of the market kind of going back or pulling back or correcting again. Now, as we know, the market actually continued throughout here, but you don't know, especially because volatility is still kind of high here, it could easily turn back around.
Well, and also to add one last thing to that, an efficient market doesn't go up 8, 10, 12% in 2.5 or 3 weeks. We know that that's a risky environment. Well, we want to avoid these one-day outliers that would exceed 1.5, 1.25%. And we want our portfolio to be stable regardless of what the environment is outside. So we'll move to the next chart. And you can see as we stabilize the portfolio in February, it's up about 3% or so over the next previous 3 months. And actually, we're happy with that. Now, you can say, well, the market went up 10% in 3 months. Well, I don't think
Markets typically don't do that.
they don't do that. I don't think many people were predicting it. And it could have, if it went up 10%, it could have just as easily gone down 10%. So again, this is a portfolio management strategy. We've kept this portfolio efficient, except for this one area where you get the sharp drop. And in that case, we had to wait for this rebound to begin to adapt. And now it's acting really like a normal portfolio in a normal environment.
And we'll now we're going to demonstrating, what an efficient portfolio kind of is and how we go about making sure we're maintaining an efficient portfolio. And so the first example we're going to show you is strategic portfolio management.
Right.
And it's on kind of an example of a combination of 3 different asset allocators, but this is what we consider to be a moderately conservative portfolio, dating back to the beginning of 2007. So the top part illustrates that moderately conservative portfolio. And then we can see this green line right here. I just turned it red with that highlighting, but it's green and it is representing a 10% drawdown from peak value. We call this a 10% confidence band.
Yeah, and the reason that that's important is we know that since markets are liquid and they're going to fluctuate, a normal correction can happen at any time. So that 8 to 10, 12% is noise in the market. Our objective, and everyone's objective, is really pretty similar in that we want long-term compounding. We only make money when the portfolio puts in a new high. And it can put in a new high a lot faster if your biggest declines 8, 10, 12% as opposed to 20 or 25%.
And then down below in this lower half, right down in here, we can see the portfolio efficiency score. So Canterbury uses a portfolio efficiency score to measure how efficient a portfolio is trading and whether or not it's maintaining these 10 and 12% confidence bands. And so a score between 70 and 100 is considered to be efficient. The yellow zone, which is between 60 and 70, is considered to be, kind of rising risk, whereas the red zone down in here is inefficient. And you can see that since this portfolio is static and only rebalances once a year, it's going to do whatever the market is going to dictate. So as you can see in 2008, it takes a tube shot downward. Well, the portfolio has long been inefficient. And then even when it becomes efficient in here, you're still nowhere near putting in a new high, which would be back in this area here.
Yeah, I think the important point here is that a heavily diversified portfolio works well in a bullish environment. And we can see that if you go to the very far left, that combination of securities was efficient and had low volatility. But as you go out further into 2008, that moderately conservative allocation ultimately became very aggressive, and our benefit of the diversification was very low. This is why the portfolio needs to adapt to the environment, because our objective is to keep this portfolio efficiency score in the green area and not allow it to go into the red, or if it does, it should only be there for a very short period.
Until you make the necessary adjustments.
Right.
And we can see that on the next slide when we show the Canterbury portfolio thermostat. So here's a chart of the Canterbury portfolio thermostat. You can see those same green and red, or 10 and 12% confidence bands right below it from peak portfolio values. And then below, we can again see the portfolio efficiency score. And so, as you'll notice, about 99.5% of the time, the portfolio efficiency score is within this green zone. So it's maintaining portfolio efficiency. And then kind of in this area and this area here, we can see that portfolio efficiency score dip into the yellow or even the red zone. But the portfolio only stays there for a very short amount of time until it can make the necessary adjustments to then adapt to get back into the efficiency zone. Now, if we go a bit further out here, I can have Tom explain.
Well, yeah, and you can tell that even though it dips into the yellow, that green is at 10%, 10, 12%. We're all within that range of noise. Now, if we go to the far right, you can see it's efficient and then drops down into the red. And the question would be, well, why didn't you adapt this? Why didn't you go ahead and buy inverse securities or alternative securities to get that back up in the green? Well, the reason is that this decline happened very quickly. If we would have made it efficient, added inverse, by the time we got this kickback rally, we would have only gotten a fraction of that. So the way the model is set up is we have to wait for this kickback rally, and once we get the rally, which tends to happen in very short order, then we stabilized it. And you can see the efficiency picking up here on the far right. And as a matter of fact, the efficiency score as of today is right at 100.
And so that's all we have for this update on what's sort of been happening in the markets, along with our portfolio efficiency score. I would advise you to read the following disclaimer disclosure. And with that, we hope you have a great rest of your week.
Yes, thank you.